insurance and ensures your clients are getting the most up-to-date solutions. She joined LLIS in 2005 and has paved her way to covering various types of disability and critical care insurance. Here to share all her knowledge for disability insurance is Kathy Bilodeau.
Thanks, Claudia. Good afternoon, everyone, and thank you for tuning in to this afternoon's presentation. Today's presentation is meant to inform you of the various insurance ways that LLIS can protect your client's business in the event that they or one of their partners or a key employee becomes disabled. Now, keep in mind that disability insurance is just one type of protection that you hope you never have to use, but you're glad it's there just in case. So we're going to cover a lot of ground today. These are some of the topics we're going to be talking about. The first one is business overhead. And then we're going to talk about business loan protection, which could be piggybacked into the business overhead. And then we're going to talk about key person, which is, in case your key person becomes disabled, how you can generate some revenue for that. And then we're also going to talk about buyout, which you might be familiar with on the life insurance side, but we're going to talk about it on the disability side. And then some multi-life discounts that we can offer your clients, up to 30% in some cases. And then specialty coverage, which sometimes if you're talking to me, I'll say this is our Lloyd's of London coverage. And then group coverage. We offer a variety of different group products now that I want to share with you. And then lastly, we've taken on short-term disabilities. So this is something that we can offer your clients as well. Now, since we're talking about small businesses today, I thought I would share some facts with you. First of all, did you know that there are 28 million small businesses in the U.S. and they provide jobs for up to 56 million people? Also, there's 99.7 businesses in the country, and 99.7 account for them being small businesses, which is just fascinating to me. And they only generate a revenue of $500,000 or less. And most of them, actually 42%, are S corporations. Now, some other statistics that are not as favorable are that only 2/3 of small businesses survive beyond 2 years, half survive 5 years, and only 1/3 survive 10 years or more in business. So based upon this information, there are a lot of small businesses, but many of them don't survive past 10 years, and they probably would benefit by having a financial planner assisting them, such as yourselves, which is the whole purpose of today's presentation. So you might be asking yourself, well, how do I approach these business owner clients of mine? What do I do? Well, the first thing you do is you ask this probing question. Mr. Business Owner, if you were to go out on vacation for 6 months, who and how would your business run while you're gone? Well, the first thing they're going to say is, whoa. I would never go on vacation for 6 months because what? My business wouldn't be able to survive without me. Well, that's exactly what you want them to say. This is exactly what you want to hear, because the reality is they've never thought about taking a vacation for 6 months, nor have they talked about the possibility of maybe being disabled for 6 months. So this identifies the areas of concern that will help you determine which protection is going to be applicable in their type of situation. And you can also point out that there's a 79% chance that a 3-owner business is going to have one owner out for 3 months or more. Additionally, 60% of business owners are using a financial planner. This is great. That means they're not out surfing the net or Googling how to take care of their business. But the bad news is that only 46% of business owners have business protection, even though in a survey they indicated that this was their #1 priority. So this is all the more reason for you to have a deep conversation with your business owner client. So you might be saying to yourself, well, who needs business planning? Well, here's some helpful hints. Small and medium-sized groups, 4 or less owners. Anything more than that, it's going to get a little complicated. They have to have one location. Again, multiple locations is going to make it too complicated. They have to be either a service or a professional type of company. And by service, I mean CPAs, law firms, architects, engineers. Professional could be a doctor, a dentist, optometrist, chiropractor. And they have to be in business at least 5 years or more. Okay, so now we've talked about how to identify who's a good lead for it. We've identified how to talk to your client about it. Now let's talk about the types of business protection there is. So the first one, and the one that we see most often, is called business overhead expense, or it might be referred to as BOE. And what BOE does is it provides a monthly benefit to the disabled business owner to help pay the bills. So in other words, we want to keep the doors open. We need to pay the salaries of the employees. We need to pay the rent. We need to pay the utilities, things like that. So that's what business overhead does. And we're going to go into greater detail on all of these. The next one is business loan protection. So let's say your business owner has taken out a loan. Well, we don't want them to have to take money out of their business overhead to try and pay that loan. We will dedicate a certain monthly amount to pay that loan. And the next one is key person. Key person is a benefit that's paid to the that's paid by the insurance company to the business in the event that a key person becomes disabled. And then lastly, we have disability buyout. I'm sure all of you have heard of life insurance for buyout, but we're going to talk about disability, which is not as common, but I think it's probably needed even more so. So what business disability buyout does is it provides a benefit to the disabled owner by the working share owners of the company so that they can have the revenue available to buy out the disabled owner's share of the business. So let's go into greater detail with each of these. So the first one we're going to talk about is business overhead. And again, this allows the business to operate continuously, smoothly when an owner is too sick or too injured to run the business. And more importantly, we want to make sure that there's a business there for that person to come back to. And that's what business overhead is going to help with. So when we talk about it, when an advisor asks me about business overhead, what I usually tell them is, I'm sorry, these are kind of confused. Oh, that we have some stipulations, and those are the business has to have no less than or no more than 8 owners, because again, it gets a little complicated. And other businesses like the ones that we talked about, doctors, dentists, things like that, can have 1 to 4 owners. And again, it provides that monthly benefit to help pay the expenses. And then this just sort of reiterates, you know, if you have like a one-man shop, like a dentist or a doctor, with them not being there, it can obviously have a negative impact on how that business is going to operate and the amount of revenue that's going to come in. So when an advisor asks me about business overhead, I usually send them to our website. And if you go to llis.com and then you click on advisor services, you're going to see something called the business overhead worksheet. And what this does is it gives you an overview of reimbursable expenses. And I emphasize reimbursable. I created this worksheet because these are what are known as reimbursable expenses in the eyes of the insurance company. Your business owner might have other expenses such as meals and entertainment and maybe parking and things like that. But what these are ones that are legitimately reimbursable by an insurance company. So keep in mind that the expenses must be deductible for federal income tax purposes, and each one of these expenses cannot exceed what it was 12 months prior. So we can't have this huge increase. It has to be, you know, somewhat normal from one year to the next. And if you go to our website, you can request a disability quote, which is what we'll need. And then in the comment sections, you would indicate that this is for business overhead. If you have any questions on that, you know, obviously you can reach out to me. So let's go into greater detail on business overhead and the details of the plan. So when we choose the benefit amount, we can get up to a maximum of $50,000 a month if you're going to have a 60 or a 90-day elimination period. And for those of you who don't know what an elimination period is, the elimination period is the period of time where the client is not getting any benefits paid to them. This is the time where they're sort of waiting for the benefits to be paid. Okay, So if you can hold out for 60 or 90 days, then you're going to be eligible for a higher monthly benefit. If you need to have that money sooner, then you're going to get a $30,000 a month benefit. So obviously, if their expenses don't need 30 or 50, we're going to obviously run the quote for a lower amount. So again, I want to emphasize that this is reimbursement based. So for instance, if you have a situation where your client has $20,000 a month planned, so if they were to incur $20,000 a month in expenses, they're going to be reimbursed $20,000 as long as they're eligible. But let's say they only incur $15,000 in expenses. Well, then you're not going to get $20,000. You're only going to get $15,000 because, again, this is reimbursable. The expenses have to be paid first. Then you submit it to the insurance company. They reimburse you. And then essentially what you're doing is you're using that benefit towards the next month's expenses. And again, I just explained we have a 30, 60, or 90-day elimination period. So, you would have to talk that over with your business owner and see how long he could extend that out. And then the benefit period, we usually choose 12 to 30 months. Essentially, the benefit period just means that what time frame you think it's going to be before, that business owner is going to come back. Now, most of the time, if they're not back within 24 months, they're probably not going to make it back. So this is, again, a decision that will have to be made. The longer the benefit period, the higher the premium. So that's something to take into consideration. And obviously, you're going to have to look at the cash flow of the business, in order to see, what they can afford with regard to the plan. Okay. So here's an example for you. This is a case where we have Mike. He's a dentist, and he's 28 years old. And he was concerned because he's a one-man shop that if he wasn't there to perform the vast majority of the dental work, which generates the vast majority of the revenue, that things would start to go south. So he knew that he had a dental hygienist that could probably clean teeth and do some minor checkups, but he did have a colleague that he knew could come in and be a substitute dentist to keep the practice going, several days out of the week. So he elected to choose a business overhead plan that was going to cover $20,000 of monthly expenses. Now, even though he has $28,000, only $20,000 were legitimately eligible to be reimbursed. He chose a 30-day elimination period because he didn't have a lot of cash flow sitting around to pay those bills himself. And he did a 12-month benefit period. He kind of decided that if he wasn't back in 12 months, things were pretty serious and that he wouldn't be able to ask that colleague to do the practice much longer, okay? So just keep in mind, these are legitimate expenses. So his annual premium is about $2,500. So, this gives him peace of mind that in case something should happen to him, he's got some protection in place. Now, additionally, we can piggyback what is known as a business loan protection rider on the business overhead, or if they're not interested in business overhead, we can just do a separate standalone business loan protection plan. So how common is it for a business owner to have a loan? Well, I looked into this, and this is what I found. The Small Business Administration provides annual loans of over $600 billion. The average loan is about $663,000, but only half of the applicants apply for $100,000 or less. Here's the sad news. 1 in 6 loans that were given from 2006 to 2015 went into default. The average loan default is about 4.7 years. So all the more reason to talk to your client about having this business loan protection in place. In addition, it does help if the client is going to go to a lending institution, you can tell them that you're going to have this loan protection, and that kind of sways them to be more apt to give the loan. So let's dive into some of the details of the business overhead with the loan protection. Again, fee for service, we're going to be using 1 to 8 owners. Other businesses, 1 to 4. It pays the monthly obligation via reimbursement or assign. So if you're going to reimburse, then you got to pay the loan first. You get the reimbursement from the insurance company, and then you use that to pay the next month. Or you can assign it directly to the lending institution or the vendor, whoever has the loan. And then these are some of the types of loans that are eligible for it. And again, good candidates for these are those CPAs, law firms, architects, dentists, optometrists. So just keep that in the back of your mind when you're thinking about your business owner clients, which ones would be good candidates. So the details of the business loan protection are it's eligible until the end of the obligation. Lots of times we see loans for 10 or 15 years, but they can go up to 30 years, and there has to be at least a minimum of 3 years. It cannot exceed the loan termination date. So obviously, if it's a 10 or a 15-year loan, then it's as far as it's going to go, or the maximum, which is the retirement age 65. And it's got to be for something legitimate. Your business owner purchased some equipment, maybe some land or a building, and you'll know by looking at it if this is a legitimate business loan. It can't be something of a personal nature. So here's an example. We have Sarah. She's a dentist, and she's 31 years old, and she purchased a retiring dentist practice, and she needed to have a plan in place because he's retiring, and if something were to happen to her, he wanted to make sure that he would still be able to collect the debt that she owes him. So she took out coverage for a loan for $250,000 for 10 years. She didn't have a lot of cash flow sitting around, so she chose a 30-day elimination period. And this is going to pay a monthly benefit of approximately $2,100 a month. And the annual premium on this one is $924. So again, this gives her and the retiring dentist peace of mind. In case she's too ill or too injured to work, her debt will still be paid, as opposed to her swimming or being buried in debt if she were to become disabled. So has anyone ever heard of key person disability? Probably not. I'm sure a lot of you heard on the life insurance side, but it's not very common on the disability side. As a matter of fact, there's only one insurance company that offers key person disability, but I hope by the end of my presentation, you'll know more about key person disability. So when you're speaking with your business owner clients, you need to remember to ask this question. What do you want to see happen if one of your key employees becomes too sick or too hurt to work? So again, when you start asking these probing questions, it forces them to think about situations they normally might not even be contemplating. And it can be difficult. It could be uncomfortable, but that's what your job is. Your job is to find out where there's holes in their protection, and we need to fill them. And again, this is what I'm here to help you with. So let's go into key person. How are you going to identify who a key person is? You're going to help your business owner identify it because you're going to find out that they must be critical to the business. They can't own more than 50% of the business. They can only be insured under one entity, regardless of how many branches or how many different organizations, we can only insure them under one. They have to be under the age of 55. They must be working full-time and earn at least $30,000. And lastly, they must be employed in that key position for at least 12 months. This is not something where you hire on someone, a new gun, and we're going to give them a plan immediately. We have to make sure that they've kind of done their probationary period and have been identified as a key person within that particular organization. So sometimes you feel like you need to use a megaphone to get your client's attention, especially when you need to ask important questions like what I've been talking about. So for the instance of key person, you might ask your client, how long can your business operate if your key employee becomes disabled? And again, have they thought about this? Have they even considered this? Ask another one. Would your client continue to pay the key employee if he or she became disabled? Have they even given that any thought? Would they pay them, or would they go without any pay at all? And then, is there a funding vehicle in place to pay the key employee if you decide to pay them? So keep in mind, key person coverage allows your client to keep their business going if something happens to that key person. And right about now, you're probably going, how does this work? I don't understand. Well, what key person does is it provides a benefit to the insurance, or from the insurance company to the employer. So the employer or the owner of the business takes out a policy and they become the policy owner. They pay the premium on it, and the key employee is the insured. They do not get any benefit from this at all, but they are the insured. And what happens is, in the event that the key employee becomes disabled, the insurance company is going to pay the benefit to the employer tax-free, and you can choose a benefit period from 12 to 30 months. And what most people do with this is they use this money to kind of, I don't know what the word is that you want to use, is to kind of keep the company running without that person, with the anticipation that they might come back. They might hire a temporary person. It might be that you don't want to hire someone and you're just going to use it to replace the lost revenue of maybe that chief technology officer or maybe that superstar, salesperson, because you just don't want to say, okay, they're never coming back. This is one of those waiting games where you kind of have to make a determination. And at some point, you have to say, okay, it doesn't look like they're coming back and we need to hire someone. And you can use this money to hire maybe an executive search firm to try and find a replacement. So here's an example that I think all of you can relate to, because all of you are financial planners. So this could be you, it could be one of your fellow colleagues, it might be someone, a friend that you know, but it's important that you guys follow your own advice and make sure that you or your business has coverage. So this is what is known as a combination plan, where we have Amy, she's a CFP, she's 36 years old, and her financial planning firm recognized that she was a key person. She's doing an awful lot of work, she's generated a lot of revenue, and if something were to happen to her, what are we going to do? So they purchased what is known as a combination plan. And what I mean by that is it has a monthly benefit and it also has a lump sum. So they're going to get a monthly benefit of $17,700, for a certain amount of time, and then at the end of that time, they're going to get a lump sum. So after 90 days, they're going to start getting $17,775, and then after 12 months, because you take into consideration the 3-month elimination period and then the 9-month benefit period, the lump sum of $215,000 is going to be paid out. So essentially, if she's not back in a year, they will at least have this money available to replace her or to at least replace the lost revenue. So make sure your business is protected, like this financial planning group did, by taking out a key person policy on their superstar financial planner, Amy. Okay, so now we're going to talk about buyout. And buyout, again, you're probably familiar with this with life insurance, but maybe not so much with disability. So what you may not have realized is that 41% of business owners don't have a written business continuation plan. Here again, you need to ask the probing question, because lots of times they don't even want to think about this. They're so busy operating their business. They're so busy, running their dental practice or their doctor practice. This is not stuff that they want to think about, and this is where you come in. In addition, 58% of business owners have never even had their business valued, which is one of the fundamental things when you're doing buyout. And then the top 3 funding vehicles are cash flow, 59%, life insurance, 44%, and then a whopping 17% for disability buyout. And this is what's disappointing, is because disability is more likely to happen than a premature death, but yet we only have 17% coverage. So that's not really that impressive. But hopefully this presentation is going to open your eyes to informing your business owner clients that we need to do some due diligence and we need to cover some of these topics to make sure they're covered. You never want a client to come back to you, a year or 2 later and say, this has happened, but yet you could have introduced me to some insurance that would have helped me in this situation. It's one thing if we introduce it and they say no, but if we've never introduced it, then shame on us to a certain extent. So what buyout does is it provides funds to purchase a totally disabled business owner's interest under the buy-sell agreement. So it's kind of like, well, what do we do now? When something happens, what do we do now? We have the buy-sell agreement in place. There doesn't necessarily have to be a buy-sell agreement at the time of application, but obviously at the time of claim there has to be, and we'll go into that in greater detail. So in the event that someone becomes disabled, what are the other owners or the other partners, what are their options? Well, they can use business revenue to buy out the disabled owner, but what if there's not enough business revenue? What if it's going to take a while to generate that much revenue to buy them out, and yet you've got this disabled owner that's maybe chomping at the bit to get some sort of income? Or you, the other partners, can go to a loan situation, but I don't know how favorable it's going to look to a bank if you go to them and say, hey, we need to take a loan out to buy out our disabled partner who, you know, is a main part of the business or one of our big revenue makers. So that's not going to look too favorable. And then you have to sell shares of the business for capital. I don't think that's a good option because obviously that's going to devalue the company, and depending upon what the situation is with the company, it may not be an option at all. So here again, you know, if you have the buyout insurance in place, this makes it very easy to help that business owner out that's disabled get his share of the business. So again, here's some of the particulars: business owner 1 to 4, small business, you know, $5 million or less in revenue. Again, I mentioned the buy-sell doesn't have to be in place at the time of application, but at the time of claim, it has to be for obvious reasons. And then some of our carriers offer a free business valuation. So if that seems to be a hurdle for your business owner clients, we can make sure that that gets taken care of free of charge. So here's some of the particulars. Minimum ownership has to be at least 10%. The maximum benefit is $3 million. Now, the elimination period that you see here is based upon a time frame where there's no monthly benefit being paid. It's just going to be a lump sum after 365 or 540 or 730 days. Now, if you do the combination where it's a lump sum at the end and then you're also paying a monthly, which you can do the combination, or you can just do a lump sum, or you can just do a monthly. But depending upon what you're doing, then the benefit period can be 24, 36, or 60 months. And again, this is something that we would kind of have to decide, you know, what the costs are, what's affordable. So just remember that the effects of a disabled owner are far-reaching. You know, they don't always realize that not only does it affect them, but it affects their family, it affects the employees, it affects their customers, it affects their vendors. So again, this is where you need to come in and remind them of what could happen and what effects it has on the entire business. So the disability buyout premiums are not deductible by the business, but the benefits are received tax-free. So, you know, there's some guidelines for each one of these plans with regard to if they're tax deductible or not. So here's an example. We have Sarah. She's age 39 and she's a smoker. I point that out because her premiums are going to be a little different. Mike, he's age 41. Now they're both restaurant owners, and they recognize that running a restaurant is very time consuming and very demanding. And they needed to protect themselves in case something happened to one of them. So they both purchased a disability buyout that will provide them with $550,000 after a 365-day elimination period. So this is what we would call a lump sum because there is no other monthly benefit that's coming in. They're just going to wait the year and then obviously pay out that benefit. Okay, and then her premium is $3,349. He has the exact same plan, and his annual premium is $2,200. And I'm just going to pause here for a moment, and I'm just going to look at some of these questions. Okay, so the first question is, on BOE, would the insurance company still pay out even if the company is generating income? Example, a disabled investment advisor earning management fees while disabled. Yes, it's going to depend on the revenue that's being generated and how much can be paid. But as long as they're considered disabled by claims, then they're going to be eligible for those benefits. So that's more of a claims situation. Can't you just use a standard ONOC DI policy for business owners instead of business loan protection? So yes, you can, but when you use a standard disability policy, the individual policy is made primarily to pay your personal expenses. So your mortgage, your loans, if you have a loan on your car, put your kids through college, all that kind of stuff, is your personal, your medical bills. If you're on disability, you have to keep in mind you're probably going to have a lot more medical bills. So it's hard for someone to live on just the small disability benefit they have versus maybe their entire salary that they're used to, maybe a bonus and commission. So to try to squeeze a loan payment out could be difficult on a personal disability plan. So that's why we usually offer a separate disability business loan so they don't have to worry about that. And then what's the typical definition on these types of policies? Own, hybrid, any, I'm not quite sure what that means, so I'll have to address that a little bit later. Okay, so we talked about all the benefits of buyout, but what are some of the things that we need to keep in mind with regard to what's not eligible for buyout? So this is an ideal solution, but some situations are not ideal. The first one is all owners have to be on board. So if you have a 4-owner group and you've only got 3 people interested, it's not going to work. Okay, we need everybody on board. Second, it can't be a close family member. So we can't have a mother, daughter, father, son, or anything where it looks like they would get the business regardless. The insurance company's concern is the son is probably going to inherit the business anyway. If it's an in-law, they'll accept that. If it's a cousin, something like that. But anyone who's immediately related to the owner, that's not going to work. There can't be a large gap between the owners. So we can't have someone who's 30 and someone who's 55 because it looks too much like a retirement plan. So it has to be people who are close in age, both in their 40s, both in their 50s, both in their 30s, something like that. And then, the last thing is they all have to be on board and insurable. So it might be that one of the owners is not insurable, and then that's going to present a problem. So we'll do what we can, obviously, to work around those, but these are just some obvious things I wanted to point out. So this is kind of a new thing that's come out. I'm not quite sure if you guys are familiar with it. It's called the one-way buyout. And this might work with a lot of you in certain situations, even within your own organizations. So you have an owner and you have one other person, and it's the key person. And you're basically transferring the business from the owner to the key person. And it might be someone who you've taken under your wing and you want them to get the business, and you've been training and working with them, and they know your clients. So this is what we call the one-way buyout. And what it is, it's a transfer between the owner and the key person, because the key person buys the policy to fund the agreement between the owner and himself. And in this case, we have to have the agreement up and running, signed, sealed, and delivered. We can't wait until claim. The requirement also is there has to be gross revenues of $500,000 or more. So again, $500,000 or more, the buy-sell agreement has to be in place. So with the one-way buyout, it's a maximum of $1 million, where with the other one it was $3 million. It's a tax-free benefit if paid with after-tax dollars, which is usually pretty obvious. The buy-sell agreement is usually a cross-purchase or an entity purchase. And then the buyer must be listed in the agreement prior to applying, which is what I just indicated. Some businesses that I think would be ideal for this type of situation, like what we just talked about, financial planners, maybe a construction company, law practice, dental office, some sort of maybe technology consulting. These would all be good candidates for the one-way buyout, okay? So some of you might have heard me talk about the multi-life. So just like a lot of you that are tuning in today, 98 of you, to hear this presentation, this is where multi-life is very similar. The more, the better. So some of our insurance companies offer discounts if you have a mutual employer with 3 or more lives or 3 or more employees. So keep in mind that multi-life pertains to individual. Can't stress that enough. These are individual policies such as individual disability, individual business overhead, individual key person, individual buyout. They're all individually underwritten, okay? So the way multi-life works is the requirements are they have to have a common employer. All three have to work for the same employer. It can be a branch, but as long as the parent company is the same. We have to have at least 3 lives. They are unisex rates, which is great for women because women pay more for disability insurance than males do. So this kind of levels the playing field a little bit, and we get a little bit more of a discount. The discount can be as much as 30%, and we're going to talk about the breakdown in just a minute. But the great thing is even if, you know, we have 3 lives or 4 lives or 5 lives, and 1 or 2 leave the employer and they move across country and they're working for somebody else, it doesn't affect the policy and the discount. Everybody still keeps their discount, and we can continue to add to it. So like if we replace that person and we add someone back on, we just put them on the plan and they get the 30% discount. So that's one of the great features about it, is that the discount goes with them. All right, so this is a case. It was with St. Lucie Medical Center. And in 2014, I had a financial advisor call me about some ER doctors that were getting ready to launch into their career. They just finished their residency, and they were looking for some disability insurance. And I said, well, that's great, because with 3 of them, we could offer a 30% discount. And he said, well, I don't understand. What's the 30% discount? Well, it's 20% because we have 3 lives, and then we add on an additional 10% if they're willing to take a cut in any kind of mental nervous coverage. And what I mean by that is the 10% mental nervous is given if your client is willing to accept that after 24 months of them being on claim for any kind of mental nervous or substance abuse, that unless they're in some sort of hospital, whether it be a psychiatric hospital or maybe some sort of recovery hospital, rehabilitation hospital, they're not going to be eligible for benefits anymore. So they only pay benefits for 24 months on an outpatient basis, and then the benefits end unless they're in a hospital. So if they're willing to take that on and agree to it, then they get the additional 10% discount, okay? So the great thing about this is I had 3 more residents call me and say they're going through their residency program at the same hospital, and they want to piggyback onto the same plan. So we were able to add 3 more and give them the 30% discount, even though some of the original 3 weren't even with St. Lucie Medical Center anymore, okay? So again, I mentioned that it stays with them even if they leave their employer. This is another great thing, that it can be done within 1 year. And what that means is if we were to go back here, and let's say the financial planner called me and said, hey, I have 2 doctors that are interested, I would say, well, if they could get a 3rd one, then we could do a 30% discount. But if they can't find one right away, let's say we did the first 2. We did the first 2 individuals, and they had to pay the full rate. But within 1 year, if they got the male doctor to come on board, then retroactively, they would go back and refund the 2 first doctors with the discount and give them a refund of the premium as if they had paid the 30% discount all along. So that's the great thing about this is, you know, we have a year with one company, 6 months with another, and I think it's 6 months with another. So just depending upon which company, but there's some wiggle room there if someone, you know, is trying to get that 3rd person on or that 2nd person on. You know, they allow that. And again, these are unisex rates, so it's going to be more advantageous when you see women, because women have a tendency to pay more for disability because of our plumbing. We've got a lot more that can go on. We've got the whole childbearing years. So it really significantly changes the premiums when it comes to the females. Okay, so let's talk about specialty coverage. Now, you've heard me talk about Lloyd's in the past. If anybody has ever had a special situation, I'll say, oh, we can run it up Lloyd's. And Lloyd's is like the Mac Daddy. You know, sometimes you just need a big umbrella to protect someone. So, you know, I put these figures on here because I'm currently working on a case for a professional football player. I'm working on a case for a physician that makes over $850,000 a year. We already have an attorney on board that we insure, and we already have on board a jazz musician. She's a Grammy winner. So those are some of the different situations that we use Lloyd's for. Primarily, we'll do it if they have an unusual occupation or they have an inordinate amount of income coming in that cannot be covered by traditional disability carriers. Age is another one. It can go beyond the typical age 60 or 64 for an issue age. The monthly benefits exceed the traditional. So depending upon what the situation is, we can go above and beyond the maximum of like 30 or 35 a month for 35,000 a month with your traditional disability. In addition, we can have some specialty occupation language. So, you know, if we've got an orthopedic surgeon that just doesn't want to see patients because he can't do surgery, you don't want him to be forced to go in and just see patients, but yet he can't perform surgery. We can make sure that he'll be paid a benefit if he can't perform surgery, even if he can see patients. So it has a limited benefit period, usually 3 to 5 years. So it's not like an age 65 benefit period, and it is renewable. So in other words, we have to re-underwrite every 3 to 5 years, but they don't necessarily have to be medically examined. They just will look at medical records. So here's some examples of some Lloyd's of London cases that we have. We've got Norman, he's age 42 and he's a director of a fund, and his financial advisor recognized that this could be disastrous if his client became disabled at his age, because he's really making a lot of money. He's in his prime. So we chose to get him a monthly benefit of $150,000. It's a 60-month benefit period or 5 years. Obviously, he can afford a 180-day elimination period. And the annual premium on this is $16,491. And even though that might seem like a lot, you got to do the math. So the total benefit, if he was paid this, is $9 million. Okay, so $150,000 for 60 months is $9 million. And the total premiums that he's paying is $82,455. So he thought that was a good return on this protection. And here's another one. This is one in which he owns a marketing company and he's making a lot of money and he's spending a lot of money. And the advisor was concerned and he wanted me to come up with some ideas on how to protect his client in the area of life insurance, disability, retirement. So we chose Lloyd's because of the amount of monthly benefit that was needed. His income is $1.5 million. We did a monthly benefit of $65,000. Here again, 60 months or 5 years, a 90-day elimination period. And then at the end of the 5 months, he's going to get a lump sum of $3.4 million because the advisor was concerned that this guy is going through money, you know, so quickly, and he's young, that he wanted to make sure that if he wasn't able to recover from his disability, that there would be a lump sum of money there for him to live on for the rest of his life. So here again, the total payout is going to be $3.9 million. His annual premium is $27,567, but for a total payout of 3.9, his premium for the 5 years is $137,835. So again, he thought that was a good amount for, you know, what we were covering. So here's a case that I mentioned for the Lloyd's coverage. Now we didn't cover Jermichael Finley, but this is a situation where I wanted to share with you what he said about having a similar Lloyd's of London plan. He was injured in a football game against the Green Bay Packers. Well, he was a tight end for the Green Bay Packers, and he was injured against the Cleveland Browns on October 20th, 2013, at the age of 28. The injury left him, you know, somewhat paralyzed. He didn't feel anything in his extremities, and he was forced to retire on October 19th, 2015. And when he was purchasing this disability policy, this is what he had to say about the situation then. He said, "My agent and financial advisors have always preached the importance of disability insurance to me. As athletes, we often feel invincible, which is why it is so important to have advisors who you can trust and who can also take the emotion out of any situation. I don't feel the pressure that I see many athletes do because I've taken their advice. I currently have a $10 million insurance policy in place. If this injury prevents me from ever playing again, I will be able to collect on $10 million tax-free. For me, this is the equivalent of making another $16 million or $17 million in pre-tax salary. While money has absolutely nothing to do with my decision to play, I can sleep at night, maybe I can sleep at night knowing that regardless of what happens, my family is financially secure forever. Maybe the biggest odds I'll ever overcome. Disability insurance is never a fun conversation, except with me, of course. And writing those annual checks to protect myself is tough. But now more than ever, I understand the importance of protecting yourself, protecting your family, and protecting your future earnings. So I think he's a good testimonial to making sure that we have the coverage in place, because he probably didn't anticipate this type of situation happening to him. So let's switch gears and let's talk about some group coverage, because sometimes group coverage is the best solution, and it's something that I'll bring up if I think it's appropriate. And if it does make sense, then we can looking at group coverage for life, accidental death and dismemberment, short-term disability, long-term disability, vision, and dental. These are all group solutions that we offer here at LLIS. And normally what we'll need for these types of products is a census. And the census, we would have to have their name, their date of birth, their occupation, their income, the location. I have a spreadsheet that I would send to you if you're interested in some group coverage. Now with group, it's usually paid for by the employer, and all the employees usually take it. So that's some of the requirements of group coverage. So let's dive a little deeper into group solutions. So for the life insurance, the minimum is $10,000. We have to have at least 3 lives to put on the plan. So the more lives, the less underwriting. So obviously, if we only have 3 people, they're going to be doing a lot more underwriting because there's not a lot of premium coming in, and it's it's adverse risk. They have to spread that risk around. So the group long-term disability benefit is usually 60% to $6,000. Now, if you have a highly paid group, we can obviously increase that monthly benefit. But normally that's where we start at $6,000 a month. And it can go to age 65 benefit period. You can choose a 90 or 180-day elimination period. And then the group short-term disability is on a weekly basis. So long-term disability is monthly, short-term disability is weekly. So this affords a 60% to $1,500 a week benefit. The benefit period is 12 weeks. So, 3 months, 90 days. And then the elimination period is 8 days. So regardless if it's an illness or injury, the elimination period is going to be 8 days. So here's an example. We have an advisor firm who had previous coverage, but they believed they were paying way too much for it, and they had 5 employees, and they wanted me to explore other coverage options. So we were able to provide them with a monthly benefit of 60% to $6,000. The benefit period went to age 65. We had a 90-day elimination period and a 2-year ONOC. That was important to them. And the annual premium was $22.51. And they were so impressed with this because LLIS was able to replace their coverage and save them over $3,000 a year in premium. So this was something that they were really happy that they explored, and were happy to see that we offered group coverage. Now here's another one. This was an automobile dealership that was interested in some life insurance. And this one was a little funky because I couldn't quite figure out what the problem was. They had existing life insurance. It was great life insurance. The premium was great. They had 7 employees. Some of them were mechanics. Some of them were salespeople. Some of them were administrative people. But when I delved into this, I learned that they weren't really crazy about their carrier, and they wanted to make some changes to the current plan, and they weren't able to do that. So they would rather start over with scratch with us and get some quotes and classify employees, so that some of the people had to go a little bit longer time after their date of hire before they were going to be eligible for the life insurance. And they wanted that flexibility to classify people. So we were able to do that. We were giving the regular non-owners $30,000 of life insurance, and then the owners got $75,000. In addition, we were able to piggyback $20,000 if the employee wanted to purchase some additional coverage on their own. And the annual premium on this, you couldn't ask for anything less expensive. It's $139 a year. And they were very happy and have remained happy. And here's our last one. This is short-term disability. So short-term disability, these were a design company, and they were a couple, and they were fully taken care of. They had all the insurance that they needed, but they never thought about their employees. So their employees brought it to their attention that they were interested in securing some insurance. So they had 4 designers, and they asked, could we possibly look at life insurance, long-term disability, and short-term disability, and would the employer consider paying for it? Well, the advisor said that, it could be cost prohibitive, but the advisor came to us and said, maybe you could look at all these. So we did. We looked at life insurance, long-term disability, and short-term disability, and they purchased all of them. I didn't show all of them. I'm showing you the short-term disability here. So they had 4 designers, and they chose the weekly benefit of 60% to $1,500. The elimination period is 8 days, and the benefit period is 12 weeks or 3 months. And the annual premium on this is $216. So here again, the other premiums were very similar, but they look like heroes in the eyes of the insurance, or in the eyes of the employer, because here's 4 individuals who didn't have any coverage at all, and for a few $100s, the couple, the owner of the business, purchased life, long-term, and short-term disability for these employees, and they were overjoyed. And they're probably going to stay with that company now because they now have benefits. And this is something that we've been offering probably for the last couple of years, individual short-term disability. This is one that a lot of advisors were asking us about it, and so I was able to research and find out that we can offer individual short-term disability, but it's geared for a short time, generally speaking, no longer than 24 months. And it's good for clients who don't have short-term disability, maybe with their employer, or don't have any emergency cash available, to self-fund for a short-term disability. So this gives them an opportunity to purchase a short-term disability plan and just give them a little peace of mind, a little safety net, just in case. So here's some of the details on the individual short-term. So the maximum monthly benefit is $5,000, which, thus far when I've been quoting it, this seems more than adequate. The issue ages are 18 to 61, just like long-term disability, not a big deviation there. The benefit period can be as little as 3 months or 24. And here again, if someone is looking for that 90-day elimination period, where they have long-term disability with their employer, but they don't have any short-term and they don't have any emergency cash, they can purchase the short-term disability and just give it a 3-month benefit period. And then their long-term disability would kick in. And then the elimination period, this is a little kooky looking, but let me explain it. So when you have the 0 and then the /7, that means that for an injury, you could be paid immediately. So 0-day injury, 7 days illness. And the reason for that is if you're injured and your doctor determines immediately that, by virtue of your injury, in a car accident or your fall, you're not going to be able to work, you should be eligible for those benefits right away. 7 days for an illness, you might have a cold that might turn into bronchitis or maybe pneumonia. It might take a week or 10 days to determine that you're really sick and that you're not going to be able to go back to work, and you're going to need to collect those benefits. So that's why you see that 0/7. You can choose a 7-day elimination period for both. 0-14 works the exact same way, 0-day injury, 14-day sickness, or you choose the 14, 30, 60, or 90 days. So it just depends upon, what the cash flow looks like with your client, how long they can go without receiving benefits. Obviously, the longer you postpone that elimination period, the lower the benefit. Same with the benefit period. The shorter the benefit period, the lower the premium. So this is a case, Scott, he was came to me and he said, I'm going to be going on this trip, I'm going across to Europe. I don't have any long-term disability. I'm concerned if something happens to me, I'm going to be swimming with sharks. It never occurred to me that, wow, this could affect my income if I can't work. So last minute, he wanted to, get a policy issued. So we worked on what is known as a guaranteed issue. So he didn't have to show income. He didn't have to be medically examined. His income was approximately $65,000. We did a monthly benefit of $3,200. He chose a 24-month benefit period. because the elimination period was 60 days. The premium was really low. So he ended up paying $447 for this. And again, it gave him peace of mind that he was going on his trip, that he had some protection in place in case something should happen to him. So that concludes the presentation. We covered a lot of ground. We talked about business overhead, business loan, DI for key persons, buyout disability, multi-life, that 20 or 30% discount, specialty coverage primarily through Lloyd's. We talked about group coverage of life, LTD, STD, vision, dental, and then our short-term disability. So we're hoping that you'll join us at the Garrett Retreat, August 1st through the 4th. September 8th through the 11th is the XYPN Live Conference. October 1st to the 4th is the NAPA Fall Conference. And then ACP 2019 is in San Diego this year from November 12th to the 15th. I'm just going to look to see what kind of questions we have here. Isn't AD&D not worth the money because of the specifics of how one is to become disabled, loss of one arm versus two arms in a specific accident? You know, AD&D is so incredibly inexpensive, and it's not a requirement that you purchase that. But I just wanted you to know that if there was someone interested in it, we have access to AD&D. Everybody's asking, can you get copies of the slides? I do believe that these can be emailed to you. Let's see. Okay, definition of disability when the policy pays like ONOC. Okay, so for any of you who aren't familiar, because I do regular disability too, own occupation is the most sought after and most comprehensive. Essentially, it says if you cannot do the substantial material duties of your own occupation and you choose to, okay, quotes around that, if you choose to, you don't have to, but if you choose to work in another occupation, you collect 100% of the income from your new occupation plus 100% of the disability benefit. That's why it's a little bit more expensive, but that's why you want to see your doctors, your dentists, your CPAs, your attorneys, you know, with that definition, because it's very specific and it gives them the choice of whether they want to work or not and still collect their disability benefit. Okay. Some things that make LLIS different. We do free monthly webinars like today. Next month, we've got double duties with hybrid insurance. September is Life Insurance Awareness Month, so be sure to tune into that. And then the top 10 things that make LLIS different. One that we always stress is we're not your competition. One that I always like to point out when I'm talking to new advisors is we are all salaried employees. We don't steer the business in any one direction. We try to do what you feel is best for your client. We try to pre-underwrite. We don't like to have surprises, whether it be a decline or you know, anything else. We proudly sponsor NAPA, XYPN, Garrett, NAPA Genesis, Alliance of Comprehensive Planners. We have specialists in life, disability, me, and in group. And then we also offer our advanced premium emails and our notification of term expiration. So those of you who aren't familiar, we do have our ALICE system that allows you to look at all your clients' policies. And during the application phase, if they're just applying now, they'll be able to see where they are in the process. You're kept in the loop the entire time. And this concludes the presentation. If there's any more questions, feel free to put them on the chat and I'll get to them. If you have a personal preference, there is a survey that will be sent out after this. You can also do a question on the survey. You're welcome to email me at any time. You obviously have my email address here on this final slide. You're also welcome to call me. I have several advisors who call me about a case if they're not quite sure how to approach it on the quote request at LLIS.com. So how do we set up an ALICE? You call me. I do all the new advisor orientation. So I explain how LLIS works. I get you set up in ALICE. And then if you want, you can work with me exclusively. So I get to know your personal preferences and I can teach you all about disability. And, you know, we can have a great working relationship. Let's see, is there any other questions? Nope, that's it. It's according to my clock, it's 5 o'clock. This concludes the presentation. I look forward to hearing from some of you. And I hope you found this interesting. I hope you found it helpful. And more than anything, I just want you to make sure that you're doing your due diligence with your business owners. Thank you.